here with the trade day takeaways is Yahoo Finance's Jared Blickery. Jared.
Thank you, Josh. It is a wrap for January, so let's go over the numbers, and what a crazy end to the month. I will say the S&P 500 eked out a gain for the week, so it snaps, I believe, a 2-week losing streak, but here are some of the major indices that I'm watching here now. In the very left, we got the SOX. That's a Philly chip index. That's up 12.9% in January. That year-to-date covers us month-to-date as well. Then the S&P 600, that's small caps, up 5.5%. And the Russell 2000 is right here. In between, we got the Dow Transports. But why would the S&P 600 be up a little bit more? Well, they only include profitable companies, and those companies with better balance sheets did a bit better. So we got the transport small caps. Then we got micro caps here. This is the CRISPR CRSP microcap index, up almost 5%. Then we got mid caps, and then on the second row we got the Dow Jones Industrial Average. That was up 1.7%. So the S&P 500 up 1.4%. That is important. The S&P 500 being up in January, that portends a good year. Over 80% of the time, if you're up in January, you are up the entire year. We're not in the clear yet, but it's a good start. NASDAQ 100, 1.2. NASDAQ Composite, a little less than 1%. MAG 7, that's the ETF that was almost just about break even here, only up about 30 basis points. And then here's software. I wanted to show you that at one end of the tech spectrum, all the way up in the upper left, we got the SOX up almost 13%, and then software down 14.5%. And if you take a look at the NASDAQ year to date, you can see some of that here. Microsoft down 11%. And some of the chip stocks also didn't do that well. Here's Broadcom down 4.3%. Not all tech was good. Apple down 4.6%. Of course, we came off a number of big earnings this week. But check out what the semiconductors look like and all that bright green there. Some of these names up. Look in the upper left. SanDisk up 140%. Micron up 45%. Now here's software. And that is just another bearish story. And you can see some of the worst performers here: Hubs, HubSpot, Atlassian, Intuit, Nutanix, all of those down more than 20%. So it was a game of have and have-nots within tech. But I'll show you last thing here for this little bit. This is our large cap sectors. Energy was in the lead, up 14%. We saw a big rally in crude oil over the last few days, up to $65 a barrel or thereabouts. Then we got materials. That's your gold and silver trade and the miners. Then we got staples, a little defensive, industrials, real estate, communication services. What didn't do well, financials. We just came off of some disappointing earnings for them a week or two ago. And then tech, just finishing barely in the red there, Josh.
What about the Fed and this Warsh guy folks are talking about?
Yeah, hawkish Kevin. You know, you and I were talking this morning, and we were looking at some of the market action and the commentary around the dollar. Could it have been Kevin? People thinking that he's actually a hawk. I was dubious, but then I read as much as I could about this. I looked at the tape during the day, and I saw the dollar climbing amid the headlines. And indeed, it does look like the market thinks that Kevin is a hawk, despite the fact that he just dissented in favor of a rate cut at the last meeting. But we didn't see the bond market move that much. We did see the dollar move. So let me show you a 3-year chart here. And what I've been looking at is this range. And I'm going to have to zoom in on this, but just take note that this is a kind of a range over the last year. And I'm going to show you the 1-year chart now, because we dipped just under it and then we climbed above it. And you can really see that on the 10-day. So here's that false breakdown, and now we're back above. It doesn't look like much, but this could be a washout. That could be a false breakdown with a move to the upside. So what I'm going to be watching for, like a hawk in the first few days and few weeks of February, is to see if we get continuation. If the dollar continues to climb there, that's going to put another kibosh on the cryptocurrency trade, the commodities trade, and potentially some other risk-sensitive areas, maybe even stocks themselves.
I feel like you want to talk about the metals.
Oh. Do we? We got to talk about silver. Worst day in history. I got data going back to 1952.
That's the worst day in history.
In history. No. It's not even close. No. There was no day in history where silver lost more than 20%. It was 30% today. Just silver crushed. There's no way else to phrase it but that. So I'm going to put our commodities heat map on here. If you give me a second, I'll show you what happened year to date. And just keep in mind that a lot of this happened today. Let's see, where did silver? So silver actually finished, I think, in positive territory. Where do we have SI equals F? So it's up 19.6%. Decent month for silver, right? But check this out. Intraday, it was down 26%. Here's the year-to-date chart, and here we were basically around $120 intraday, above that, and then we just crashed today. So why was that? I think it was the stronger dollar and maybe the Warsh factor there, but also it was the end of the month. And sometimes when you have a huge run-up like this, you do get into a profit-taking scenario, and then profit-taking, if it gets exacerbated by the shorts, and we saw huge short interest in silver, well, that can get to margin calls. And I was just watching it intraday. I could see the margin calls coming in. I could see it, just the waterfall getting redder and redder and redder. So it was just amazing to watch today. I haven't seen anything like this in commodities in a long time.
All right, thank you, buddy.
You bet.
Appreciate it.
As we saw there up on the screen, those Apple shares are flagging a little bit because of some concerns around margins. You took the opportunity to actually upgrade the stock because you were really wowed by those numbers, right, and by the forecast. I'm curious how worried you are about the margin issue. Obviously not worried enough to not upgrade the stock.
Yeah. So when we look at the March quarter as a starting point, despite supply constraints and despite potential inflation as it pertains to memory, Apple guided to 13 to 16% revenue growth and a very healthy gross margin of 48 to 49%. Now, the company does not provide an outlook beyond the next quarter. So I do think that there is potential that the higher memory prices could affect Apple and could affect the margins. But I would say working in its favor is that Tim Cook is excellent at managing supply chain, and with the very surprisingly strong demand for the iPhone 17 lineup, there could be an opportunity to take price. So I'm a lot less concerned about the margin outlook for the second half of this year for those reasons.
Okay, Tom, I actually want to play what Tim Cook had to say about the memory chip pricing issue on the call. Let's play that.
Memory had a minimal impact on the Q1, so the December quarter gross margin. We do expect it to be a bit more of an impact to the Q2 gross margin. We do continue to see market pricing for memory increasing significantly. As always, we'll look at a range of options to deal with that.
So I guess the question is, what does that range of options include, Tom? And for example, do you think that that Apple's going to raise iPhone prices this year?
Yeah. So again, I think that the surprise, at least to me, was how strong the iPhone lineup has performed, despite Apple really having a substandard AI solution. So I actually think that's very bullish coming out of the quarter. And because of the strength of the demand, I think it does have pricing power. The other potential advantage would be for memory prices to come down later this year. And then again, I think that the strength in managing the supply chain is why I'm less concerned than maybe the market is by the flattish performance of the stock, despite the blowout quarter and excellent outlook for the March quarter.
You and I have talked about the AI story, or lack thereof, with Apple before. And as we've talked about, our tech editor, Dan Halley, says he's not convinced that people are going to buy an iPhone because of the AI, just like they weren't buying it because of Siri, for example. I know you feel a little bit differently about that. Do you think that Apple is starting to make some more significant progress on that front?
So first off, I think that the strategic partnership with Google essentially de-risks AI for Apple as it relates to investors' concerns about it. Now, what's going to sound strange view here is that I think that being slow to have an AI product is actually working in Apple's favor, because I think you're seeing a lot of consumers recognize that there's, for example, a lot of hallucinations going on, and that some of the other companies that have AI products on the market today, those products aren't necessarily perfect, and in many cases are flawed. So I actually think that and again, I didn't think it would play out this way at all. But the being slow to market with AI, actually, I think it has worked in Apple's favor. But the good news is, and yes, I'm skeptical like Dan that Siri is going to be materially better when enhanced with AI. But I do think that over time, I expect Apple to at least be at par with the market when it comes to consumer services related to AI.
Tom, kind of to your point about the delay, like, have we figured out what the killer app is in terms of AI usefulness on the phone?
So it seems like, so I also wonder, Julie, about the OpenAI ability to generate a profitable business from AI. So stepping back and just looking at AI at the industry level rather than Apple specific. So I think it's unclear. If you look at Meta platforms, they're clearly benefiting from using artificial intelligence to improve the relevancy of their advertising and improve their digital advertising effort. But that would be more of I guess, a commercial solution for AI than necessarily one as a consumer. There's a lot of usage as it relates to search, but I anecdotally feel that Gemini isn't necessarily materially better than what I see from the legacy search results from Google and things of that nature. So yeah, I think, again, it's unclear to me what the killer consumer app is as it pertains to AI, and I think that's benefiting Apple in being slow to market.
And obviously we've seen yet more headlines on OpenAI. Amazon, for example, reportedly considering an investment in the company. As you think about that sort of ecosystem, if you will, Tom, are there other interesting investing opportunities at that point, especially since we've seen a little bit of a wavering in the AI investment enthusiasm so far this year, seemingly among investors?
Well, what I like, Julie, is I feel like investors are being thoughtful and saying, where's the return on the investment spend? And I want to get more comfortable that there is going to be a return on the investment spend because the level of investment spending is just enormous. And then I guess the good news or bad news of having covered the internet since '96 is it reminds me of your company, so Yahoo, the early days of the internet, when it had a disproportionate amount of advertising revenue from startups. And I worry that Amazon, companies that I don't cover like Oracle and Microsoft, are over dependent on OpenAI to the extent that this is still a startup, a very highly valued one, but again, they haven't figured out what their long-term business model is and if they could generate a profit. So I guess my concern for AI is that, we'll go with Amazon, that it may be over-dependent on some of these startups when it comes to either cloud computing revenue or things of that nature. So that's the risk that I'm trying to monitor.
Dan Ives coming to you. Apple, you like this quarter?
Look, it was a phenomenal quarter. I mean, if you think about what we saw specifically with iPhone in China, I mean, that was robust tailwind, services strong. Look, but I think the issue with the stock, I mean, investors, it's all about AI. Investors want to see what the strategy is, what the monetization. Obviously, it's Cook keeping it, sort of close to the vest. But I think that ultimately is really going to be the key to why, we're bullish. And I think what you see is this is almost a sleepy, sort of pretty massive upgrade cycle that's taken place.
Dan, are you in a Wedbush office? I've never seen you in the office before. It's a lot for me to take in, Dan.
Look, there's a lot going on, Taz. I had to, I wanted to kind of blow your mind. So I'm in the office today. And, again, it's Friday. Who knew?
Well, count my mind as blown. Melissa, over to you. Dan brings up a good point, talking AI and Apple. How much AI initiatives for Apple, AI, the broader environment, how much of that is priced into Apple stock, you think?
Yeah, it's a tricky one. First of all, happy Friday. Thanks for having me on. I mean, there's a couple of interesting things going on from the quarter. I mean, they beat Visible Alpha consensus on the top line pretty nicely and also at the gross margin. But what really stood out to us was China. China beat consensus by over 20%. So I think, when we think about AI and we think about the second half, the question's going to be is what is going to be the catalyst for those numbers? What's going to drive top line? What's going to drive further upside in the gross margin? Is China going to be sustainable, and are they going to pull something magical out of their hat in the second half around AI?
Is that magical thing, Inez, you think it's this Google Gemini? I mean, Big Tim, he didn't want to get into the financial ramifications of this type of Google, but I mean, it's hard to tell how excited he was. That's just Tim Cook, but he sure seemed excited, and he sure seemed to think this could be a big lift to Apple over time.
Yeah, and it may be the perfect partnership for them, at least for the time being, and them having such a massive quarter. This could give them the runway, so to speak, for a even broader AI strategy later on. So even though investors were so concerned about AI last year, this could be a stopgap measure, as Dan Howley had been mentioning earlier, and this could be the perfect fit for right now. I thought that what was interesting was the memory comment on the earnings call, because that seems to be sort of a bifurcation that we're seeing now in the market with respect to some of these memory names that have been skyrocketing and the demand, the bottleneck when it comes to memory.
You're seeing there around the screen, that move in SanDisk, Dan, I mean, holy SH*T. I mean, I don't know how do I put it. I mean, if you have missed this run in SanDisk, I would even say Micron, do you buy, or is this just going to end badly?
No, look, it's a super cycle in memory. I mean, that's the reality. I think if you look at what's happening, and we see it with like SK when we're there in Korea, Micron's part of the AI 30 list, in terms of that we focus on. Look, I think this is it's picks and shovels, right? In other words, like, this is a fourth industrial revolution. And I think investors, what you see in SanDisk today, what you've seen in these numbers, it shows, it's still early days in this just massive cycle.
Melissa, what really impressed me with Apple, a lot of things, the iPhone revenue, but Tim Cook got on that earnings call and he said, you know what, we're going to drive higher margins in the first quarter, higher than the street expected, even with these memory price, these higher memory prices, these memory chip complaints. Isn't that the ultimate buy signal on Apple?
I mean, ultimately what was a surprise was the gross margin, especially coming into the outlook. I mean, they guided 48, 49% gross margin. Visible Alpha consensus was 47.5, and we're currently at 47.5 for the second half. So that's what the market has priced in. So as my other two guests alluded to around memory, this is the question. Is Tim Cook going to be able to manage the supply chain and memory prices in a way that enables them to maintain and sustain those 48, 49% gross margins, or is the 47.5% the real number?
And as I promised, I'm going to get you on precious metals in a second. Hold on just a moment. Dan, while we're cheering Apple here, Google's going to report soon, probably a good quarter for them. I'm going to talk up Gemini. On the other side, this move lower in software stocks, SAP, Salesforce, ServiceNow, this has been abysmal. I mean, do you try to pick a bottom here, or do you just stay with the winners like an Apple and a Google?
Look, software, it's a guilty till proven innocent. And I think ServiceNow and obviously Microsoft and others, I mean, this is just on the street right now. It's almost a do not enter zone. Now, I think a lot of that maybe is overdone specifically for some of the cybersecurity names, for even Salesforce and others. Look, it comes down to monetization fees. And that's what the street wants to see here. And I think what you're seeing is really a bifurcation in tech. It's kind of the haves and the have-nots. And that's really what's playing out across tech earnings season.
Inez, wild moves in precious metals the past 24 hours.
Incredible what we've seen with the moves in precious metals. We're looking at now gold that's down about 5%. It's at around $5,000 per ounce. You just had yesterday morning, it was touching around 5,600. So it's a massive move to the downside. Silver as well, down 13%. Mike McGlone over at Bloomberg is basically saying you may have just seen the top on silver, and this could be for years now that you won't see those same silver prices as you've seen. He's been warning about this massive speed in this rally that we've seen. And we're also looking at other metals as as well that are down. I mean, you're looking at copper. Also, copper was up around above 14,000 per ton in London, and that has also moved lower. That doesn't take away from sort of this narrative that we've been hearing about, is the demand for these metals, for the demand for copper that you're going to need for data centers, for electrification, et cetera. But look, there's inelasticity when it comes to that, because a data center is not going to stop being built just because you've got higher copper prices. But nevertheless, a lot of this has to do also with China's speculative trading as well. So analysts had been warning this parabolic move. You can't have these types of parabolic moves without having some type of a downturn at some point.
Melissa, humor me on this. We started this session today with news that President Trump has nominated Kevin Warsh to be the next Fed chairman. If you're out there, and I'm going to get this question for people, so I'm going to put it right to an expert like you. No pressure, right?
No pressure.
No pressure. Does Kevin Warsh, how much of a factor should he be when you're trying to pick a tech or media stock to invest in? Should you even be thinking about who the next Fed chair will be? Why or why not?
I mean, ultimately, it's going to be about policy and their view about interest rates. Interest rates are an important dimension to the way that the market thinks about asset allocation. So I think if his view is to lower interest rates and take a much more dovish stance around rates, that may be a signal for small cap. It may be a signal for some of the riskier, more unique areas of the market. It may also be pretty bearish for the dollar. We've been in an environment where the dollar has been very strong. And so if we see that start to reverse, it could change some of the dynamics in the market.
All right, we'll have to leave it there. Stay warm, y'all. Thank you so much for this fiery analysis to kick off the day. Appreciate it.
What do you think of this pick? What do you think the markets think of this pick? And what kind of Fed chair ultimately is Kevin Warsh going to be?
Well, he definitely has a great resume, without a doubt. He is a pragmatist, as you mentioned. He has had some experience of being a hawk. Now he seems to be a dove. But I think he's going to be flexible. I think it's actually kind of fascinating that we got a fairly solid citizen here as a nominee. It kind of makes you wonder whether we needed all the drama that came with it. Of course, it's not a sure thing that he's going to get through Congress, but I think he will, as long as the administration signals that they're going to back off on attacking Jerome Powell. Let him move on and let Warsh come in.
We'll see if that happens, Ed. I mean, listen, we certainly didn't need all the drama, but the guy in charge, he likes drama, Ed. So
he likes drama.
So I think that's what we can expect going forward. I'm curious, when you talk about Warsh's resume, I know that he has come under some criticism by some folks around his commentary around the great financial crisis, when he thought that the Fed should not be as stimulative necessarily with its balance sheet. Is there anything we can sort of say, draw any lessons we can look at from that time to now?
Well, I think most economists would agree that QE1 was a necessary injection of liquidity. The question about QE2, QE3 is very controversial. I agree with the position that we only needed that liquidity round, and the rest was not necessary. And zero interest rates were also an extreme abnormality back then. But that, we all learn from our jobs, learning by doing. I suspect he's had a lot of that.
Yes, very fair point, Ed. Now, as you pointed out, we've heard some murmurings that Thom Tillis might try to hold up this nomination unless and until the criminal charges against Jay Powell are dropped.
Right.
any market implications if this gets held up for a significant period?
Yeah, I don't think it's going to get held up because I think the administration is going to back off on attacking Powell. There's no benefits in doing that. I mean, Powell's only mistake was that he didn't bring the project manager and an engineer when questions were asked about the renovation of the Fed. He clearly was out of his depth, and he just should have said, "I really don't know anything about that. I'll send you a letter."
Right.
So I mean, they got him on a picayune charge, quite honestly, and I think this too shall pass. Look, the administration's takes a tough, dramatic stand, as we just agreed, and then they kind of back off. They've done that on Greenland. They seem to be doing that maybe in Minneapolis. It looks like we're going to get a avoided government shutdown, and now we know who the Fed chair is. So there's a lot of uncertainties that actually are behind us.
Yeah, thank goodness. I'm also curious if you think that this Warsh pick makes it more or less likely that Powell will stay on the committee even if he is no longer chair.
Well, I'll quote the Fed Chair Powell. I have nothing for you on that. Who knows? If I was him, I'd say, enough's enough. Let's go fishing or play with the grandchildren.
Yeah, I mean, according to recent reports, that is his strong inclination, unless he feels like he has to stay.
Yeah, he doesn't really.
Yeah, I mean, I who could blame him, really, Ed? As for that confirmation hearing, when it does happen, what do you think the most important questions for Warsh are?
Well, I think Congress is going to dig deep into his loyalty to Trump. I mean, to what extent will he be independent of Trump? He should be completely independent of Trump, but clearly Trump has made it an issue. The problem for anybody who was going to be Fed chair is it's kind of the position got tainted by the politicization of the whole subject. So I think there's going to be a lot of questions on his independence. And does he agree that the Fed funds rate should be down to 1%? And I don't know how he's going to dance around that one because that's what Trump's been saying he wants. And there's no way that other Fed voters agree with that.
Speaking of other Fed voters, Christopher Waller was out with a statement this morning explaining his dissent, which was quite interesting. Among other things, he said last year's data will be revised downward soon to likely show that there was virtually no growth in payroll employment in 2025, zero, zip, nada. And he said, let this sink in for a moment, zero job growth versus an average of almost 2 million for the 10 years prior to 2025. He says this does not remotely look like a healthy labor market. Do you agree, Ed?
Well, I think there's a lot of moving parts to explain what's going on here. And I'm not quite sure. I'm relatively sure that lowering interest rates isn't going to fix the labor market. There's issues with lots of kids coming out of school with student loans and with degrees that are very ambiguous about what their skills actually are. I think there's a huge mismatch between what the economy needs. So let's face it, we need a lot of plumbers and we need a lot of roofers and people in basic trades, and that's not what's coming out of college.
So what do you think we fix? How do we fix that? How do you fix that labor mismatch?
I think time will fix it. This is a major technological change that's going on in our economy right now, and it takes a while for people to kind of figure it out and reinvent themselves. I think we're seeing part of the fix in new business applications. They rose to 5 million, all-time record high of 5 million last year. I think a lot of people are saying, the heck with it. I'm not going to bother sending another round of 300 resumes. I'm just going to see if I can raise some money from the family or a bank or a credit card, and I'm going to start my own business.
And Ed, you talked about all of the sort of like lingering uncertainties that we had at the beginning of this year, some of which are now seeming to be resolved. I know that you're looking for gains in stocks this year.
Yeah.
Anything that's happened thus far that has shaken you from that conviction, including the earnings we've seen so far?
No, I think the earnings outlook is great. The analysts thought it would be up 8% year over year coming into the fourth quarter. I think the numbers are going to be more like 10 to 12%. We've had really 3 quarters in a row now where earnings have been a lot better. We're going to have record earnings in the fourth quarter. I think that's pretty much a layup. We had record earnings in the third quarter, and earnings are really what drives the economy in the sense that profitable companies expand. They increase their spending on capital. In the past, they used to increase their payrolls, and the initial unemployment claims data and the continuing claims data give me some hope here that just as we've all given up on job expansion, suddenly it'll occur again. Maybe all that's been going on here is companies froze hiring until they figured out what AI could and could not do, and they're going to conclude that it can't do everything.
So it has been a really interesting year so far, in the short year so far for industrials, because we've started to see some rotation, some broadening that everybody has been waiting for so long. What do you think have been some of the tailwinds that have gotten folks back interested in the industrials?
I think every year when the calendar turns, there's a bit more optimism around industrial production in the U.S., capital spending, this kind of U.S. onshoring theme that's been happening, I guess, or at least talked about for, it feels like over 10 years now. And every year that comes around, with the prior year being relatively sluggish, hope kind of springs eternal that we're going to inflect in the coming year. And that's been part of this rotation that's really been happening since last October, when there was a stark realization that the data center build out, which has been a huge driver of growth for my sector and industrials broadly, was happening. And all these results came in really strong on that front. Those stocks had a nice move. And the divergence between those growth stocks and your kind of run-of-the-mill industrial got too wide. And that reversion has been happening really for 3 months, but is kind of carried into this year as well.
Yeah, and indeed, to your point, industrials were also the third best performing group for all of last year. They were up something like 18% as a group. So I guess that begs the question, will these hopes finally be realized this year? Will we see another year of that kind of outperformance broadly throughout the sector?
Just keep in mind, industrials is a broad universe. So
Sure.
I cover 20 stocks, and I would say there's 5 or 6 of them that have exposure to this data center theme. So that would be basically like our Mag 7, if you will. And those stocks continue to trade at a pretty significant premium and probably carried the majority of that outperformance last year. So make no mistake, the growth game in town remains AI, or as we call it in the industrial world, because it's a bit more tangible, data center build out. So that is the key driver. Outside of data center, I would call it a sluggish recovery, but a recovery. Things are getting better. Order trends are improving, but I think the term inflection is thrown around way too much. It's a recovery, but it's relatively sluggish. Look at CapEx budgets that have come out. Oil and gas obviously is a key part of the CapEx economy, and Chevron, Exxon today really kind of subdued CapEx for 2026. And the run-of-the-mill industrial player outside of maybe life sciences or semis is not really spending much more capital. There's still a lot of uncertainty out there, geopolitics, demand, most importantly. So I'd say recovering, but at a pretty moderate pace.
And so if that's the case, when you look at those data center exposed names, is it too late, do you think, for investors to get in because there's already been a big move in some of them?
No. I think that these stocks there's been a healthy skepticism around the term bubble, which I think has been written about now in many forms in the last 6 to 9 months. For the growth that you're getting in these stocks, they're actually trading at relatively attractive multiples. So I think in this build out, we're probably in inning 2 or 3, assuming AI development continues at pace. The data center build out of the pipelines we see is probably innings 2 or 3, not inning 6 or 7. So we're still, I'd say, not in pregame warmups, but earlier in the cycle, which means these companies are going to be growing and beating and raising probably for the next 2 to 3 years. And we're very comfortable that the valuations today on this recent pullback don't reflect all that upside in earnings.
Let's talk about, let's name names, shall we, Steve? Okay, let's talk about Vertiv, for example. So this is one that makes switches, so it's levered to this data center thing, but its valuation is a little bit higher, right? So, but I know it's also one of your top picks. So why are you thinking that valuation is worth it at this stage?
So typically, we're in a growth market, in my view. Earnings are still growing, so we're not in a kind of defensive mode. And typically, my group, run-of-the-mill kind of diversified industrials, trades at around a 2x PE to growth rate. Basically, what that's doing is just discounting, the future earnings are more visible from a growth perspective, and they're a lot cheaper in kind of the out years. That's all kind of the PEG reflects. Vertiv, we believe, will be growing earnings 40% plus in 26, and probably another 30% in 2027. The stock's trading at about 30 times earnings, so that is less than a 1 times PEG. So for us, if you look at it on kind of an out-year basis and where these backlogs are positioned and how the pipelines look, valuation is actually not a concern. And ultimately, with that kind of earnings growth, the bottom line is you don't really need multiple expansion. You're going to be getting 30, 40% earnings growth at least this year, and then next year, still very attractive versus a group and I guess the S&P that's growing earnings at, a 10% rate and trades at 20 times. So I think these high valuations make a lot of sense in the context of the growth here. And honestly, a couple of them look relatively attractive for the growth that you're getting out there.
Let's talk about another of your picks, and that's Honeywell. Honeywell's had, a lot of swings over the past couple of years. Of course, it's remaking itself. It still is set to spin off its aerospace division. Is this one that also has sort of a data center peg? Are there, it's still sort of a diversified industrial. Are there other reasons that you like this one?
Different animal, idiosyncratic, some of the parts play. I know that's a lot of like Wall Street jargon, but basically it's meant to say it's a company-specific play. They're breaking themselves up, and when you break yourself up, you become an asset value play. And the majority of their EBITDA and value is in aerospace. Right now, aerospace is probably the second best market behind data center. Very visible growth probably for the next 5 to 6 years. Decent amount of defense exposure here. We know how dangerous this world is and how those budgets are going up. And so Honeywell at a 15 times EBITDA multiple with 50% of their EBITDA in aerospace, which is trading at a 22 EBITDA multiple, suggests that you're getting the RemainCo assets, which are pretty solid industrial assets, for a pretty significant discount to my group. If you mark that to market today, we get to around 200 and about $80 a share. That's a pretty steep discount to some of the parts, and they're going to be breaking up in June. So you can kind of buy that RemainCo for very cheap today in the consolidated Honeywell. So a little bit different than the data center growth side. They don't really have that to a degree, but aerospace is kind of second best and definitely not reflected in their multiple.
I always like a self-aware jargon call out there, Steve. Appreciate that. And then just quickly want to touch on Johnson Controls, because this is also not one I think of as a data center play. So why is this on your top picks list?
I'm kind of realizing this, but they're on different parts of the barbell, and JCI is right in the middle.
Gotcha.
So JCI makes HVAC, heating, ventilation, air conditioning, as well as fire and security equipment for buildings. And some of those buildings, they're a leader in data center cooling. It's about 15% of their sales, so that is driving a lot of growth. Orders are strong. They have visibility to above average revenue growth, not quite like Vertiv. Vertiv's growing revenues 20 to 25%. These guys probably grow mid to high single digits. But this is a company that was put together through acquisitions over a 20-year period, some portfolio moves that didn't quite work out, and they weren't quite integrated and operated well. They have a new CEO that came from Danaher, which has a tremendous legacy of operations, and he has visibility to substantial margin opportunity that we would call idiosyncratic margin opportunity. So unlike Honeywell, where there's kind of a sum of the parts play here that's idiosyncratic, this one is much more about taking that above average growth and then driving much more margin expansion. That leads to a comfortably above average 20% plus EPS growth, and it's trading in the mid-20s. So a PEG that is comfortably below 2. So somewhere in between the two, idiosyncratic margin and data center exposure, but very attractive from that perspective. Also a bit of a defensive business model, so we don't have to worry when things roll over. This is not a bad place to be.
Steve, great to catch up with you. Thanks so much.
I think it really is a combination of a couple things. One, we really focused on getting the operational excellence back into the stores. And really what that's all about is our Green Apron Service program, which is all about becoming a great customer service company again, and then also setting our partners up so that they have the tools and the time to do their craft and connection with our customers. And I think that's at the foundation for why you saw the transaction growth. And then you mentioned Tressie. She's done a phenomenal job from putting the brand back in culture, and I think leading in culture, from fun things like the glass barista to, my personal favorite now, the protein latte. That really attracted both rewards customers and non-rewards customers to come into Starbucks again. And then when they got in there, they had just a great experience with our partners.
Let me follow up on that one real quick, Brian. What's the average wait time now? When you started, what was it, over 5 minutes or so?
It was. So in cafe, unfortunately, we were probably closer to 6 minutes. And now we are below 4 minutes at peak when you come in for the cafe order. If you go through the drive-thru, you'll get it in less than 4 minutes during peak. And then obviously on mobile order pickup, we want to be on time and accurate. And that's really what the Green Apron service model has been all about, is setting our partners up with clear operating standards, but then also giving them the tools and frankly the rosters and the hours to then do their craft and create that human-to-human connection.
And Brian, the look and the feel of Starbucks is different. And you mentioned yesterday at the Investor Day that the overturn of a remodeling could just be overnight even. You also got the cost down. So what can consumers expect as far as the look and the feel goes? Yeah, look, I'm really excited about this. We're calling it an uplift. I think my grandparents called it a zhuzh. But look, we need to put great seats into our stores. We need to give you a great atmosphere. And we can do that overnight. We've got really talented designers that are looking at every single store to figure out how we put a great seat back in, give you a great experience where when you come in, it feels warm, it feels welcoming, it's a place you want to stay. Then at the same time, we have a huge opportunity to build a lot more stores in the United States and frankly around the world. And we want to make sure we're building the right store. And so that cafe that we're going to build is going to be just that. It's going to be a warm, welcoming coffee house. In a lot of cases, it'll also have a drive-through, but we always will have a great coffee house. And it seems like you're sort of leaning into like the nostalgia factor here. You have the 1971 coffee coming back. You're also having a reserve card. I don't know if you have your gold card still, but they're coming back out with the black reserve. You have to earn the points. You have to earn the points to get it. But it seems like you're leaning into this nostalgia, leaning into Pike Place. One, is that the factor here? Are you leaning into the nostalgia factor? And two, have you talked to Howard Schultz about what you're doing?
Well, look, first, I would say it's not nostalgia. We're just leaning into the soul of Starbucks. And look, Starbucks started in 1971 in a great little quaint coffee shop, Pike Place. I don't know if you've been to it in Seattle. And we want to bring that to life. And the 1971 dark roast is exactly what that is. And then I think the whole idea on the rewards program is we wanted to make the program more personalized. With the technology now that we have, the use of AI, we can actually be more personalized and give people the rewards that match up with how you interact with the brand. That's why we're going to have the reserve level, the gold level, and the green level. Look, I hope everybody becomes a reserve card-carrying Starbucks holder, because that means they are really engaged with the brand and a big fan of the brand. And then look, working at Starbucks, I think it's a real fortunate fact that I have the access to Howard, so I can hear how did this company go from a handful of coffee shops to 40,000 iconic around the world brand. And look, he's been always available, and he's been a big supporter of the team that I put together and the strategy around Back to Starbucks.
I thought this notion of a third place that Howard created was done and dusted. I mean, why do we have time to sit in a Starbucks like we used to and read a book and drink coffee? Look, not all the time, but there are those moments where you do, and I think it is the soul of the brand. I think it is a halo to all those other occasions. I do also believe people prefer to go into a place than go into a place that's soulless and has no real
connection or experience. So whether that's you're going through the drive-thru and you see it through the window, or whether it's a mobile order pickup, where remember, you're coming into the cafe. You know, I shared this at Investor Day. Just in the last month, 60% of our customers had at least one transaction where they came to our counter. That doesn't include the mobile order pickup. So look, the cafe is a big brand component of who we are. And I also think too, it is human nature. You want to actually connect. Even if you want to be by yourself, you prefer to be by yourself with a lot of people around you.
One of the interesting things with coffee chains, and it was, I think at a competitor, I saw a slide deck like a decade ago, I think it was Dunkin'. I mean, their transactions go right down in the afternoon. Now you said at Investor Day, we're focused on building another peak in the afternoon. How large is that opportunity if you are able to build a strong, consistent afternoon business with wraps, energy drinks, and even different types of matcha tea?
Yeah, look, I think the afternoon is a multi-billion-dollar opportunity for us. You know, I think we set out initially to win the morning. We're actually doing that. We already have an afternoon business, but I just believe we are not totally to bright on what the menu, both in food and beverage, needs to be. And I think now with a great cafe, people actually have a reset moment in the afternoon. You know, some days you're on your way to go get a workout, so you need protein, right? Or maybe you need more energy. Or other days you're like, man, I'm having a day, and you're gonna enjoy a Frappuccino. But it's like, we can have the food, we can have the beverage for that reset in the afternoon. If you actually look around the world, everybody around the world has a reset moment. And I think the United States will actually really appreciate having a reset moment. And I think we can do that with our capabilities around beverages and food. And, you know, I think we can have a peak that's just as powerful in the afternoon that we have in the morning.
Brian, you're also at this moment in time where consumers are using GLP-1s. About 25% of US households have at least one GLP-1 user. When you think about innovating with protein, how difficult will that be for you to do with your supply chain? It's not like people are cutting up ingredients like they were at Chipotle.
Well, you know, look, I think actually we're positioned really well for this, because what I've noticed, and as I've understood the behaviors associated with people that ultimately are on GLP-1s, you end up with more snacking or smaller meals. And more protein forward, more fiber forward. And so we can do those things. And then also, you know, look, I think complementing food with a drink like that is right in the wheelhouse of that trend of using GLP-1. So that's another reason why I'm really optimistic. You know, if we can start doing more protein forward solutions, I think you might have heard Tressie mention protein balls and potentially wraps that are a little bit more protein forward.
Ball?
You never had one?
No.
Oh, you haven't seen these? These are usually, it's like oats, peanut butter, dates,
syrup. On the go.
Okay.
Yeah.
Fair enough.
Don't worry. Welcome to the trend.
Yeah, thanks. Brian, the time we have left, I know you've had a busy week. You and I go back to Yum Brands Investor Day in New York City. I mean, it had been like 10 years ago, whatever it was.
I think it was a little longer.
Maybe a little longer than that. Okay, but then Chipotle, and now it's Starbucks. I was surprised this week with that filing on your security. It's something you and I have never even talked about. And full stop, I mean, this has to suck for you to have to go through like this where you're trying to drive a turnaround. Like, how is this role, not that Chipotle was a low profile gig by any stretch of the imagination, but how has this role changed your daily life?
Yeah, look, that's probably something I underestimated coming in. You know, I knew it was a global iconic brand, but, you know, I appreciate that people are passionate about our brand, but there are also things that I just didn't expect. And, you know, you wouldn't think you would need the additional security, but, you know, it turns out you do, because unfortunately, a lot of crazy things are being said out there. And look, the good news is, on the whole, I do believe, I'm an optimist, so I believe sometimes it's more, and I hope this is the case, more just words than really true beliefs or actions. But, you know, look, it's a little concerning, and I appreciate that our company takes it serious, and, you know, it's important for me to make sure that everybody's safe.
Does it make your job as a CEO just even more hard? Because, look, you're thousands of stores, a brand we all know, and in many respects, I mean, many people love, and you're trying to drive a turnaround. And I mean, do you walk out of your house like looking left and right? Like, is that what it has come to here? Because this is wild stuff.
Yeah, you know, look, this is why you don't have to do that, because I know I've got a great group of people doing what they're really good at on the security side of things, so that I don't have to worry about that. And, you know, I'm fortunate that, again, our board, and ultimately our company takes it really serious. And it took a little bit for me to, frankly, warm up to the idea. But yeah, it's just something you got to adopt, and hopefully down the road it becomes less necessary.
Still able to get in those 5 a.m. workouts?
I do. That's a big part of I think keeping your health is a really big piece of the puzzle in order to keep up with the demands of the job.